This presentation is brought to you by Workforce Solutions Northeast Texas.
Having a credit card is not a bad thing. However, you must know how to use it and how it can affect your future. Today, we will discuss using credit cards appropriately. Credit cards are a convenient form of borrowing. People generally use credit cards to purchase goods and services. Credit cards provide a revolving line of credit. This means you can make an unlimited number of purchases up to a pre-approved dollar limit. The limit might be $500, $1,000, $3,000, or much more. You must pay at least a part of the bill every month. This is called a minimum payment. It is often a certain percentage of your balance. Debit cards are similar to credit cards, except they are tied to your checking account at a bank. When you make a purchase, the money is immediately taken out of your checking account. Have you ever received pre-approved credit card offers in the mail? Many people often do. These offers tell the recipient that he or she is pre-approved to receive a credit card. This means the bank offering the card has looked at your credit report and determined you might qualify for the interest rates and credit limit being offered. Whether or not you get the best rates depends on your income, employment, and credit history. Before applying for a credit card, decide what it will be used for. Keep in mind a credit card is not free money. It is a loan you must repay with interest, so be sure to read the agreement carefully. Before signing up for a credit card, consider these tips. How will you use the credit card? Decide ahead of time when and how you plan to use it. Will you pay your balance in full each month? Remember, small charges add up quick. Start small. Do not charge too much on your credit card until you get comfortable with the monthly bill. Understand the terms of the plan before you accept the card. Shop around for the plan that fits you. Make sure you read and keep the fine print. Beware of introductory rates. You might start out with a credit card that has no annual fee for the first year, but you will be charged a fee in the second year. You might start out with a low interest rate and then find the interest rate is much higher after a few months. Beware of application fees. Most credit card companies do not charge fees to open accounts. Understand fixed and variable rates, as well as penalty APRs. Let's explain the differences between the different types of credit cards. Secured cards require collateral or a deposit to obtain credit. Collateral is what you promise to give the bank if you do not repay a loan. Examples of items that can be used as collateral include cars, homes, or a savings account. You might want to consider a secured credit card if you have no credit history or have had credit problems in the past. To get a secured card, you generally need to pledge a bank savings account as collateral. This means the bank holds the savings account as security for repayment. For example, if you want a credit card with a $500 limit, the bank might require you to keep $500 in a bank savings account. You will not be able to withdraw or take money out from that account. The bank can use that $500 if you are unable to pay your credit card bill. Some banks might require more or less than the credit card limit as collateral to secure the card. Once you have a good history by paying your credit card bills on time, you will have a better chance of getting an unsecured credit card. Most credit cards are unsecured. This means you do not have to provide collateral in order to get a credit card, but you usually need a good credit history. There are many credit cards today aimed at teens and young adults. These cards typically offer very low introductory rates, or APR, and cashback bonuses. Some allow no income and no cosigner requirements. Oftentimes, there is a low credit limit and no annual fees. Reward cards are credit cards that offer rewards for using them. Many airlines and hotels offer reward cards. When you use these credit cards, you earn points towards goods or services, and you may also receive cash rebates. You can then use the points towards flights, gift certificates, and other products. You may be charged annual fees for reward cards. To use a stored value card, you deposit money up front and the balance declines as you use the card. It works like a debit card, but it's not connected to your checking account. It has a limit like a credit card does. But since you deposit money ahead of time, you don't pay it back later. You can refresh the value of the card by depositing money into your stored value card account. Depending on the type of card, stored value cards can reduce or eliminate check cashing fees, offer 24-hour access to funds, make money transfers easy, offer the ability to make purchases using credit card networks, and reduce the need to carry a lot of cash. One potential disadvantage is that your name may not be printed on the card, and a refund may not be available if your card is lost or stolen. Some examples of stored value cards include telephone cards with prepaid minutes, international gift cards that can be used anywhere the Visa, MasterCard, or American Express logo is displayed, payroll cards, which are the cards that enable your employer to deposit your paycheck on the card rather than issue a paper check, and gift cards that you can purchase at retailers such as supermarkets, restaurants, department stores, etc. A smart card resembles a credit card in size and shape, but inside it is different. The inside of a smart card usually contains a microprocessor or computer chip. The chip is under a gold contact pad on one side of the card. Think of the computer chip as replacing the usual magnetic strip on a credit or debit card. It is used in some credit and cash cards, but also for other applications such as computer security systems, wireless communication, banking, satellite TV, government identification, and loyalty systems like frequent flyer points. To start a credit card application, you need to understand the different types of credit. Individual credit is based on your own assets or things you own, income or money you make, and credit history, if you have any. In this case, only you are responsible for paying the credit card bill. Joint credit is based on the assets, income, and credit history of two people who apply. Often, young adults apply jointly with a parent or another responsible adult. In this case, both applicants are responsible for the credit card bill, no matter who makes the charges on the credit card. Most companies require the applicant to be at least 18. Now we are going to talk about some of the important credit card terms you should know. The first one is the annual percentage rate, or APR. The APR represents the cost of borrowing money. It is stated as a yearly percentage rate. If you plan to keep a balance on your credit card account, you want to look for a low APR. Your interest will be calculated by either fixed or variable rates. A fixed rate means the interest rate will not change. A variable rate means the rate can increase or decrease. The terms of your credit card agreement may also state that the creditor will permanently increase the interest rate on your credit card by a large amount if you do not pay your credit card bill on time, or if you exceed your credit limit. This is called the penalty APR and may be 2 times the regular APR. Credit card companies may offer low introductory APRs or teaser rates for a limited time to attract new customers. After the introductory period, a new rate may apply. That rate may be either fixed or variable and is usually higher than the beginning rates. Be aware of the universal default. Some lenders have policies that will raise your credit card interest rate to the highest possible rate if you are late on any other account. For example, if you have 5 credit cards and you are late paying one, the interest rate for the other 4 cards may go up. Make sure you check how much you will pay in annual fees, late fees, over-the-limit fees, balance transfer fees, and cash advance fees. If you have a good credit history, you can probably find a credit card with no annual fee. If your current card has an annual fee, call your lender and ask them to waive the annual fee. It never hurts to ask. The grace period lets you avoid finance charges by paying your balance in full before the due date. Knowing whether a card gives you a grace period is especially important if you plan to pay your account in full each month. Without a grace period, the credit card company may impose a finance charge from the date you use your card or from the date each transaction is posted to your account. Keep in mind that many credit card companies never provide a grace period for cash advances or balance transfers. If your card includes a grace period, The credit card company must mail your bill at least 21 days before the due date, so you will have enough time to pay. Many credit cards let you borrow cash from them against your credit limit. Cash advances come with a cash advance fee and typically have higher interest rates than the interest rate for purchases. The cash advance fee can be charged as a percentage of the cash advance or a flat rate. For example, your credit card issuer may charge a fee of 2% of the advance or $10, whichever is greater. Check your credit card terms to confirm the exact fee you will pay for cash advances. Cash advances do not have a grace period, meaning interest begins accruing on the balance as soon as you borrow it. To reduce the amount of interest you pay on a cash advance, pay it as soon as possible, even if that means paying before your billing statement comes. A balance transfer is the process of moving an unpaid credit card debt from one credit card to another. Debt is the amount of money you owe to the credit card company. Credit card companies sometimes offer low rates to encourage you to pay off other debts with their credit card. But be wary of balance transfer fees. Also, be sure to find out what interest rates you will be assessed after the promotional or introductory period is over. A credit report is a record of how you have paid your debts. A credit report tells creditors who you are, how much you owe other people, including how many accounts you have, how long you have had them, and how much of your credit is unused. It also tells them whether you have made payments on time, whether there is negative information about you in public records, such as collection actions, bankruptcies, and/or judgments, and how many inquiries are listed in your credit report. The inquiry section of your credit report lists the credit card companies and other authorized companies that have requested and received your credit report. Applying for new credit too frequently may be a signal to creditors that you are a higher credit risk. Inquiries can remain on your credit report for up to 2 years. Your credit report is kept on file with 3 major credit reporting agencies. They are Equifax, Experian, and TransUnion. Financial institutions report information about you to the credit reporting agencies, which combine this information in the form of a credit report. Banks then ask the credit reporting agencies for this information when you apply for a credit card. The Fair Credit Reporting Act requires each of the credit reporting agencies to provide you a free credit report annually. A person's credit report may vary across the 3 credit reporting agencies. If you have never used credit, or if your credit was never reported, you may not have a credit report. To get your free credit report, you can go online to www.annualcreditreport.com or by phone at 1-877-322-8228 or by mail at Annual Credit Report Request Service, P.O. Box 105281, Atlanta, Georgia 30348 5281. A credit score is a number that helps creditors determine how likely you are to pay your credit card bill when it is due. It is calculated based on information in your credit report. Credit card companies may use one or more credit scores. Credit scores may either be calculated by the creditor itself, or the creditor may use a score purchased from another firm. 2 of the scores that creditors may purchase from the other firms include the Fair Isaac score or FICO score, or the Vantage score. Knowing your credit score is a good idea for many reasons. Your credit score helps determine the rate and conditions you receive. If your credit scores are high, it is probably because your credit history shows you've paid your credit card bills on time, haven't maxed out your credit cards, etc. Lenders then believe it is a fairly good bet that you won't have any difficulty paying off your loan. They will see you as a low-risk investment and offer you a low interest rate with good conditions. If your scores are lower, lenders are more likely to think you are a riskier investment and charge you by loaning you money at a higher interest rate to take on the perceived risk. Your FICO score is the main factor lenders consider when deciding whether to grant you credit. A FICO score is calculated using a computer model that compares the information in your credit report to what is on the credit reports of countless other customers. It takes into account your payment history, the amount of debt you have, how long you've had credit, how many new applications for credit you have done, and the types of credit you have. FICO scores range from about 300 to 900. Generally, the higher the score, the lower the credit risk. In 2006, the 3 credit reporting agencies announced that they had agreed on a new credit scoring system called VantageScore. Because all 3 agencies will be using the same scoring system, you should have the same Vantage score from each agency. The credit number score now comes with a letter category. If your request for credit is denied, you will receive a denial notice, sometimes called an adverse action notice. If you do not receive this notice, or the notice does not explain why the credit was denied, ask the credit card company. Some of the reasons for denial may be that you have a bad credit history, you have not been at your current address or job long enough, or your income does not meet the credit card company's criteria. If you are denied because of the information on your credit report, the credit card company is required to give the name, address, and telephone number of the credit bureau that supplied the information. If you contact the credit bureau within 60 days of the denial, you are entitled to a free copy of your credit report. You have the right to dispute or argue any incorrect information listed on your credit report. Here are some tips and guidelines for using credit responsibly and maintaining good credit. Good credit will help you get better loans and even better jobs in some cases. When you miss a credit card payment or pay late, the credit card company may charge a late fee, increase your interest rate, or report the missed payment to your credit report. This may cause your credit score to drop. You can avoid paying late by setting up automatic payments as well as setting bill reminders. If you're only paying the minimum payment, keep in mind that most of that money is paying for the interest you are accruing on the principal balance and not the actual principal balance, or the actual amount borrowed from the credit card company. Let's say that you have $1,000 on your credit card, and the credit card calculates your minimum as 2.5% of your total balance. Then your minimum payment is $25 every month. If your annual interest rate or APR is set at 18%, you owe $180 a year on your $1,000 balance in interest charges. You end up paying $300 a year in minimum payments, meaning you paid $25 a month for 12 months. So that's only $120 that you're actually paying off the principal balance. That $180 you owed in interest is subtracted from the $300 you made in minimum payments. Therefore, your balance is still $880 after a year of you making monthly minimum payments. Even if your credit card calculates minimum payments differently, and you might even have a lower interest rate than 18%, your minimum payment mostly goes towards interest and not your principal balance. Be sure to use your credit card responsibly. Protect your credit card and account numbers to prevent unauthorized use. Tear up or shred receipts with numbers on them. Keep a record of your account numbers, expiration dates, and the phone numbers of each credit card issuer in a safe place, separate from your credit card, in case you need to quickly report a loss. Carry only the credit cards you think you will use, and do not exceed your limit. Never give your personal information out over the phone unless you have placed the call. If your credit card is lost or stolen, immediately notify your credit card company. Do the same thing if you spot something wrong in your monthly billing. If you suspect fraud or are a victim of fraud, you can place a fraud alert on your credit report. This will notify lenders and creditors who pull your report to take additional steps to verify your identification before they extend a credit line or loan in your name. There are 3 types of fraud alerts that can be placed on your credit report. An initial fraud alert, which will last for 90 days, is available if you are concerned about becoming a victim of fraud or ID theft. An extended fraud alert, which lasts for 7 years, is available if you are a victim of fraud or ID theft. An active duty military alert, which lasts for 1 year, is available if you are in the military and want to minimize your risk of fraud or ID theft while you are deployed. You only have to request a fraud alert through one of the credit reporting agencies. The agency you contacted will notify the other two, and alerts will be added with those agencies as well. Once you've placed a fraud alert on your credit report, you may allow it to either expire or request to have it removed prior to expiration. With only some of your personal and/or account information, someone else can pretend to be you. With a credit card in your name, a thief could open and make charges to an account in your name that you don't even know about. Once you find out about it, it could take years to completely clear your name. Always be careful when providing your personal information online. Remember, bad credit can keep you from getting a good job. There are some apps available that help you monitor your credit. With both apps shown, you will see your credit score for free, which factors affect your score, how much each factor matters, what exactly is on your credit report, and what you can do to improve your credit score. Credit Karma allows you to view both your TransUnion and Equifax score. Credit Sesame allows you to only view your TransUnion score. Credit monitoring can help spot errors on your credit report. These are more common than you might think, and they can affect your credit score. That, in turn, could lead to higher interest rates or make it difficult for you to get the credit you need. Credit monitoring also makes it easier to quickly spot suspicious activity, such as new hard inquiries made without your permission or new accounts you didn't open. Keeping an eye on your credit is a healthy financial habit, and credit monitoring is an easy way to make it part of your routine. Here's some final tips to help protect yourself from identity theft. Don't give out your personal information unless it is required by a trusted source. Check your credit report every year. Shred financial papers before throwing them away. Delete emails you didn't request. And don't visit websites emailed to you from people you don't know. Your credit and credit score represent you in the financial world, so be sure to watch your step and put your best foot forward.
If you have any questions or want to learn more about Workforce Solutions Northeast Texas, please visit us at netxworkforce.org.